Let me grab you right now. Because what just happened in the global economy is the kind of moment that divides history into before and after. I'm not exaggerating. One crack in Japan's financial system just sent shockwaves through the entire world. And if you think this won't touch your job, your bills, your savings, or your future, you're wrong. You deserve to know the truth right now, not after the fallout hits. And if you stay with me, I'm going to show you exactly why governments are panicking, why markets are shaking, and why this single event could reset the global financial order faster than anyone expected. So take a breath, lean in, and pay attention, because everything starts with the moment the world never expected. Japan's $12 T-bond market breaks, stability, global risk spikes instantly. Japan's $12 T-bond market breaks, stability, global risk spikes instantly. Yields surge as Japan loses control of its debt machine. This is not a drill. This is not one of those moments where the news hints at a problem and markets shrug it off. What just happened in Japan is the financial equivalent of a structural crack running straight down the foundation of the global economy. And if you don't understand this moment, you're going to get caught flat-footed while the world's second largest bond market sends shockwaves through everything. Currencies, equities, energy prices, emerging markets, and every government drowning in debt. You need to hear this clearly. Japan's $12 trillion bond market, once the most predictable, stable, sleep, through the night financial instrument on Earth, just broke its reputation. For 30 years, Japan has been the anchor, the steady hand, the quiet giant supplying cheap borrowing costs to the entire global system. Every central bank, every hedge fund, every multinational corporation has benefited from Japan holding yields at near zero. It's been the silent subsidy behind endless government spending and sky-high market valuations. And that era just collapsed. The moment yields in Japan surged. The warning message was unmistakable. The world's debt engine is losing pressure, and nobody knows how to stop it. Investors around the world immediately felt the tremor. Because when Japan, the champion of low rates, the mother of global liquidity, starts losing control of its debt machine, it sends a message markets hate. The rules are changing. Think about the size. $12 trillion. This isn't some small corner of the financial system. This isn't a developing economy fighting inflation. This is a G-7 powerhouse whose bonds are held everywhere. Pension funds, central banks, insurers, global asset managers. Japan is woven into everything. So when yields spike, it's like someone suddenly tightening the oxygen valve for the entire global financial system. Money doesn't move the same way. Risk doesn't price the same way. Everything gets more expensive, more volatile, more dangerous. You can feel the urgency rising across trading floors right now because investors know exactly what this means. Japan has lost its grip on the one lever it could always control: borrowing costs. And when yields rise in a country with the highest debt to GDP ratio in the developed world, the consequences are brutal. Debt becomes heavier. Refinancing becomes riskier. Budgets blow apart. Confidence evaporates. That's why global risk spiked instantly, not gradually, not cautiously, instantly. Markets understand the math. Japan is carrying over 260% debt to GDP. When your debt load is that insane, even the smallest rise in bond yields hits like a hammer. A 1% move, catastrophic. A 2% move, system shaking. And the world just watched yields jump because investors no longer believe Japan's central bank can keep suppressing them. This is where the crisis tone gets real, because the mechanism Japan relied on, decades of artificially low rates, wasn't just a policy choice, it was survival. It was the only way to stop its massive debt tower from tipping over. But inflation surged, the yen collapsed. And the Bank of Japan is trapped between two disasters: defend the yen or defend the bond market. They can't do both. So now both are starting to break. And that's why this moment is not contained inside Japan's borders. A shock like this spills everywhere, immediately. Investors holding Japanese bonds start dumping them. Investors holding as treasuries start selling to rebalance risk. European bond markets start shaking because if Japan loses control of yields, other countries with huge debts, Italy, France, the UK, look instantly more vulnerable. Emerging markets, they get hit as global liquidity tightens and capital flees. This right here is how global debt crises ignite. Not with a bang, with a sudden loss of confidence in a giant that was supposed to be unbreakable. Now add this reality. Japan has been the world's biggest buyer of foreign bonds for decades. When their domestic yields were near zero, they had to invest elsewhere to get returns. Mostly, US and European bonds. But when Japanese yields rise, they pull money back home. That creates a chain reaction. US yields rise, European yields rise, global borrowing costs rise, governments get squeezed, corporations get squeezed, consumers get squeezed. This is not a Japan problem. This is a worldwide tightening spiral, and we're watching it unfold in real time. Yields surging in Japan isn't some random anomaly. It's the symptom of a global system that pushed debt to its limits. Every major economy has been piling up obligations with the assumption that low rates would last forever. Japan was the cornerstone of that fantasy. If the cornerstone cracks, the whole structure shifts. What makes this even more alarming is how sudden the shift was. When markets sense that a government or central bank is losing control, they don't wait. They act fast. And that's exactly what happened. The second yields jumped. Investors repositioned. Risk assets fell, safe. Have flows scrambled. The yen's instability accelerated. And all at once, the calm, controlled image of Japan's bond market shattered. This isn't just a financial event. It's a psychological one. For decades, the world believed Japan could suppress volatility forever. Now that belief is breaking. And once confidence breaks, restoring it is almost impossible. The most dangerous part, Japan doesn't have the tools to fix this cleanly. If they raise rates too much, their debt becomes unpayable. If they suppress yields again, the yen collapses further, and imports become painfully expensive. If they choose middle ground, they risk losing both battles simultaneously. That is exactly why global risk spiked. Investors see the trap. They see the math. They see the limitations, and they're responding with the only strategy available in a moment like this: reduce exposure and prepare for a wider unwinding. The message this sends to the world is brutally simple. If Japan can't contain its debt problem, nobody can. The US, Europe, China, and dozens of smaller economies all built financial systems on the assumption that debt could rise endlessly because interest rates would stay low indefinitely. But the world has changed. Inflation changed it. Geopolitics changed it. Demographics changed it. And now Japan, the most rate-sensitive economy in the developed world, is being forced to confront the new reality first. This is the warning shot loud, sharp, unavoidable. Japan's $12 trillion bond market breaking stability is not just a headline. It's a sign that the era of easy money is over. And yields surging as Japan loses control of its debt machine is the clearest signal yet that the global financial system is hitting its stress limit. This is the moment you remember, because this is where the next global debt chapter begins. Faith the yen slide triggers a worldwide flight from risk assets. Central banks scramble as Japan's debt structure buckles. Asterisk, asterisk, the instant the yen broke through critical levels, global markets reacted like a fire alarm had just gone off. Investors dumped stocks, emerging market currencies, and anything remotely risky, because a falling yen signals something far more dangerous. Japan is losing control of its financial stability. As the yen sinks, the cost of Japan's massive import spikes, inflation pressures rise, and its fragile debt tower starts shaking. That's why central banks from the US to Europe moved into emergency monitoring mode. If Japan's debt structure fails, capital flows reverse at high speed, global liquidity drains, and borrowing costs surge everywhere. The world isn't watching Japan, they're bracing for the impact. FI investors dump global bonds, fearing a synchronized debt shock. Japan's rate shift destroys the era of cheap global money. Asterisk asterisk the sell. Off hit worldwide within minutes, as funds rushed out of government bonds from the US to Europe, all triggered by Japan's sudden yield spike. Markets saw the danger instantly. If Japan can't keep its borrowing costs down, no major economy is safe. This wasn't just a repositioning, it was a global repricing of risk. Japan's move shattered the decades-long assumption that rates would stay low forever. With its yields rising, the entire system that relied on cheap credit is collapsing. Governments, corporations, and consumers now face a world where money costs more and debt becomes heavier. Phase-overrain debt markets flash red as Japan's system cracks. Global liquidity tightens. The debt bubble finally hits resistance. Asterisk asterisk, the moment Japan's bond market slipped out of control, warning lights erupted across sovereign markets in Europe, the US, and emerging economies. Investors immediately demanded higher yields everywhere, signaling fear that other nations could be next. This sudden stress is choking liquidity at the exact moment global debt is at historic highs. The cheap money era that inflated government balance sheets for a decade is slamming into a wall. As liquidity evaporates, countries that relied on endless borrowing now face a harsher, more expensive reality. Market volatility erupts as Japan's financial backstop collapses. Japan's debt quake exposes fragile economies across Europe and the US asterisk asterisk. The moment Japan lost control of its bond market, global markets snapped into turbulence. Stocks whipsawed, currencies slipped, and safe haven flows surged. Investors realized the world's most reliable financial anchor had broken, and the shock immediately exposed hidden weaknesses in Western economies overloaded with debt. Europe's high-yield nations and the U.S. Treasury market reacted almost in sync, revealing how dependent they were on Japan's stability. What looked like a localized shock is now unraveling vulnerabilities everywhere. What you just heard isn't fear. It is reality. Japan's bond shock didn't stay in Japan. It rattled Europe, hit the US, slammed currencies, triggered sell-offs, and exposed how dangerously fragile the global financial system really is. This affects every person who earns a paycheck, pays a bill, or tries to build a future. But here's the empowering part. Awareness is your advantage. Most people are asleep at the wheel. Not you. You showed up. You leaned in. You chose to understand what's happening before it hit your doorstep. Stay awake, stay sharp, and don't dismiss these signals. The world is shifting, and being informed is how you stay ahead. This is USA World Reports, and our job is to make sure you're never blindsided by global events that shape your life. Thank you for watching seriously. If this opened your eyes, hit like. Share this with someone who needs to see it. And subscribe so you stay one step ahead of the global reset already underway. This movement is growing, and you're now part of it. Stay alert. More critical reports are coming.